stuck into the content right now. As we say, we're looking at technical analysis versus trading strategy because they are two different areas and they both need to be understood quite well before you can actually get into the markets and make sense of the two. First of all, please, I'd like you to have a quick read of this disclaimer. I won't take too long on here, but I would like you to have a quick read through this. Make sure you understand this and feel comfortable to go on with the webinar. I'll give you about 20 seconds to have a read through that. Okay, that should hopefully be enough time for everybody to go through that disclaimer. We've still got everybody on board, which is great. Okay, so we're into the company itself. Basically, Oanda Corporation is a financial services provider of online retail foreign exchange trading and Forex information. Now, Oanda uses innovative computer and financial technology to provide internet-based Forex trading and currency information services to everybody. Now, when I say everyone, I mean individuals to large corporations, portfolio managers to financial institutions. They really cover all bases there. Oanda provides access to one of the world's largest historical high-frequency filtered currency databases. What does that mean in plain English? You basically got all your bases covered there. Okay, a lot of data and everything you need. I got a lot of awards too. Financial Times and the Investors Chronicle 2012 Investment Awards, Best Forex Provider. The Investment Trends 2012 Singapore CFD and FX Report has given them highest overall client satisfaction. Forex Magnets Summit 2012 Forex Magnets Award, Best Forex Broker, and the International Business Times gave them the 2012 IB Times Trading Awards for Best Global Forex Broker. If you want to see more of the awards and the details of these awards, go to oanda.com/corp/news/awards to get more information on that. So getting into today's agenda, because there is quite a bit to cover there, we're going to look first of all at what is a trading strategy and why do traders actually need one. We're going to look at technical analysis, so we're going to look at learning the ingredients. We're going to look at trading strategy, learning the recipe. The way we break things down and what we're teaching you guys is through the ingredients and recipe sort of methodology, I suppose, whereby we're going to combine a number of ingredients together to provide us with a blueprint or a recipe. Now that recipe is going to be our trading strategy. First we learn the ingredients, then we learn the recipe. Then we put it all together, and then we're going to show you towards the end a little bit about something that Oanda is launching for premium for their clients that have live accounts. It's a premium course service, and it's very exciting. It's very new, and I'm sure a lot of you are going to enjoy it. So first of all, trading strategy or recipe. Business and life in general can be linked by a number of cornerstones. 1, having a good strategy or plan. 2, doing something every day towards achieving your goals. 3 is maintaining adequate capital. 4 is having a positive mindset. 5 is managing your risk to protect against the worst case scenario. And 6 is maintaining the hunger and desire to succeed. Now, 1 through 6, it's not really, there's no real surprise here as to what, one needs to do to actually achieve your goals and to work through things. And anybody who's achieved anything in life, which is all of us, we've all achieved something of some sort of distinction over the time that we've been on this planet, you understand that it takes a bit of work. Now, trading is no different, and this is why we want to structure this for you guys and help you to create this strategy or even just work into the strategies you already have. Our approach to trading is very similar to that of a business, to that of how you approach things in life. So we're going to explore this notion of trading strategy and recipe a little further and how it can be applied to trading, because it really is something that it's more than just paying lip service to having a trading strategy. And the thing is that most people that go out there in the marketplace, they know they need a strategy, and that's fine. People understand that, yes, I do need a strategy. I do need something to provide me with what we call an edge, okay? The problem is that quite often people go out there and they try and find it themselves. They try and take lots of little indicators and stick them all together and try and create something themselves. Well, what we're going to be doing here is providing you with a set of ingredients and some trading strategy that is actually tried and tested, and you guys can go ahead and adapt that to your own trading. Oops. Okay. So a trading recipe. A recipe is a set of instructions that describe how to prepare, make, or plan for something. The modern culinary recipe normally consists of the name of the dish, an ordered list of steps and methods. So everything comes in a specific order. When you're baking a cake, you don't just throw everything together and throw in the microwave. You've got to add things at a certain time, at a certain rate, at a certain pace, and then combine this and fold this and mix that to actually bring together the product that becomes the cake in the end. You need, obviously, the correct ingredients for that thing that you're putting together. You need quantities and proportions. You need time required to prepare the dish so that you know, do I need a whole week to do this? Do I need an hour? Do I need 20 minutes? What do you need? And you also need a list of equipment required to prepare this dish. Now, the good news is that most people, I would say most people, have actually gone through and used a recipe or had some sort of structured approach to something that they have gone and done in life. So you understand the principles, you understand the methodology behind having a methodical, structured approach. Now, what we're going to do is we're going to bring that methodical, structured approach to trading. The way to get consistency from your trading is to consistently trade in a manner that's runs alongside success. So what I mean by this is, if you go in, Gordon Ramsay is a chef that most people around the world are aware of now. Okay, he's that pommy bloke that swears an awful lot, and he's quite entertaining to watch on television. Love him or hate him, he does do quite well for himself, and he's a damn good cook. Now, I'm not saying that if I was to stand next to Gordon Ramsay and bake the cake from his recipe, that I'm going to come up with the exact same cake when I start. Certainly not. He's got years of experience on me. But if I'm learning from somebody who's made the recipe, if I flawlessly execute that recipe enough times and practice, then eventually I might not ever be as good as Gordon Ramsay, but at least I'll be working towards that and following the steps of a master in front of me. And what we're trying to do here is trying to give you that sort of guided approach, help you to learn these strategies and walk you through it step by step, so it's not alien when you go to the marketplace anymore. You want to go into it knowing what you need to place a trade, and this is where that recipe actually comes in. So, different trading theories. There's fundamental and there's technical analysis. They are two very, very, very different things, and being aware of that is going to help you. Now, some people will do both, okay? Personally, myself, I'm a technical analyst. I study charts, okay? So technical analysis is the study of past price changes with the intention of using their interpretation to predict future prices. Mostly concerned with volume, open interest, and price action. Now, what you'll start to see throughout this webinar and throughout the other webinars that we present, that Rwanda is presenting to you guys, is that there is a large onus on price action. Okay, a lot of the strategies are price action based, and the simple reason behind that is the price is real. It is very simple. It is price measured by time. Okay, wherever the price moves within that given space of time. It's very honest, I guess the right word to use is, and therefore it's a leading indicator that we use in a lot of the strategies that we're going to be providing you with. Fundamental analysis, on the other hand, is the study of non-price related factors which affect the value of assets. Primarily concerned with economic information such as interest rates, employment, central bank decisions, and trade data. Now, a fundamental is when, like it says here, if a fundamental piece of news comes out, like GDP, for example, and the market reacts to that piece of news, there will be traders out there, both traders that are in the retail sector that are trading for themselves and fund managers that will make decisions based on the numbers that come out. We focus more on the technical side of things, and you'll see why as we go through it. Okay, so moving into the next step, a trading recipe or strategy. A recipe is a set of instructions that describe how to prepare or plan for something. The modern culinary recipe, we've seen this. We just had a look at this a minute ago. What we're going to do is we're going to change some of these. Rather than culinary recipe, we're going to call this the trading strategy. Okay, so we're going to relate all this back to trading now so it makes logical sense in a trading fashion. The modern trading strategy normally consists of this. The name of the strategy. An ordered list of steps and method in a trading plan. As I said before, consistency in your approach. It's got a much better chance of consistency in results than just going at it and sort of stabbing wildly and trying to pick things. So we're going to have those steps to provide us with some consistency. The required technical analysis ingredients. So we're going to be looking at individual elements and combining them together in what we would call a confluence of events. We don't just trade off of one piece of information. We bring together numerous amounts of information together to provide us with that recipe to then take our trade. Quantities and proportions of risk. As a trader, we need to accept the risk, and there is a place in this particular webinar tonight that I will look into some risk with you guys. Time required to scan for new trades. And when I say scan, I mean you have a game plan, you'll have a set of rules. So when you're scanning, you can go through and go, do I have this, this, and this? If I don't have these rules, I don't even bother looking any further. So it sets you up to reject things. Equipment required to trade, i.e. a great foreign exchange broker. Okay, so a good broker is definitely something there that you will need. Okay, and that is, thankfully, who you're working with at the moment. So a little bit more on this, the whole TA versus TS trading strategy, or sorry, trading strategy is a set of rules defined in advance, which gives a plan. Okay. Now, I want to make this area very, very clear because I can tell you I spent a bit of time learning about technical analysis. I spent far too much of my early years as a trader trying to learn everything about the markets, and it really didn't serve me. I didn't make any money. It wasn't until I decided that, well, not decided, it wasn't until I actually learned from somebody who was really doing well that what I was trying to do was essentially, learn the dictionary without even using half of it. So it's important to understand the difference. So strategy is a set of rules defined in advance. So as I say, when I say going into bat, you're ready to go into the game. You know what you're going to swing at and what you're going to leave. And if you get a ball that you can swing at, you're going to swing at it. Miss it, hit it, home run, whatever. You're going to swing at it because it's in the right spot. Technical analysis, on the other hand, these are the basic building blocks of our strategy. So we need them, but one on its own is just simply not enough. Okay? We think of technical analysis as the ingredients to the strategy. So now we're going to have a look at them in a little bit more detail. Learning the ingredients. Technical analysis tools can be divided into three main categories. Number one is price action, and there's a reason why it's number one. Okay? Because it is key. It is really important that the understanding of trends, candlestick patterns, and price structure, mainly support and resistance, is understood to a point at which it's like the back of your hand. It's just second nature. You just really understand it. And I don't mean just a trend in terms of, oh, it's going up, there must be an uptrend. I mean the defining moment when that trend changes. You need to know when that is. Not because you're necessarily going to trade it, but because if you have that much of an understanding for trend, you're going to be in a much better position to be able to read support and resistance, to be able to trade off of these levels, and to understand how these things collate to come together to give us trading strategies. Number two is price patterns. Now, a number of people that have traded before will have heard of all these and a number of these. Head and shoulders. You've got triangles, flags, pennants. You've got so many price patterns. There are just copious amounts of names. That's all they are, though, is names. Remember, each of these names are price. So it's the culmination of price into some sort of formation, which then gets given a name like a head and shoulders, a triangle, flags, patterns, etc. Okay. The third section is indicators and oscillators. Now, there's a number of these. There is, well, so many of these. You could spend a lifetime trying them all out, but you need not do that. We look at RSI. There's MACD, there's stochastics, there's moving averages. There's a whole plethora of these to actually work from. We don't want to work from them all. We want to pick the ones that are actually going to help us with our strategy. Now, trend analysis can be among the most important tools in a technical trader's toolkit. The main word there being trend. Okay? Without a clear understanding of price action, other technical tools become more difficult to apply or become completely obsolete because you're not able to understand what it actually means. Without understanding what trend is, convergence and divergence will be a language all to its own. You won't know what it means. You won't know how to apply it. You won't know where it comes in and what you need to do when you see one or the other. Support and resistance without trend is really quite worthless because we're looking at support and resistance for trading opportunities. We're either trading through it, or we're targeting to it, or we're trading off of it. So there's a number of places now that when we combine trend with support and resistance, we start to get trading opportunities. Chart and candlestick patterns. What is the chart telling you and what is the candlestick telling you? Okay. Candles, the names of the candle is totally irrelevant. It's not important at all. The psychology behind the candle is what's important. And we can define all candles into 3 different names: bullish, bearish, and indecisive. You need not know anything else. Okay, just understand what those candles mean, and we will show that to you in more detail later. Technical indicators are secondary level of confirmation. Remember, they are based on price itself. So any indicator is not leading price. It's being dictated by price. So because it's a secondary level, a secondary confirmation, we use it as icing on the cake. So let's define what trends are and how we analyze them. First of all, what is a trend? Financial markets move due to supply and demand. It's like any business. An overwhelming amount of supply will usually lead to a fall in price. If everyone's flooding the market trying to sell their house, generally it's a buyer's market. You can get a good price because there's more pressure for people to sell because the market is flooded. On the flip side, if there's a lot of demand, everyone wants to buy a house, you're in more of a position to raise the price of your valued property and get more from it. It is simple supply and demand. Now, price does not move in a straight line, at least not for long anyway. It will move in cycles or waves. These are known as trends, and this is where our trading opportunities present themselves. There are just 3 types of trends, okay, so we're going to break things down and make it more understandable, easier, by not cluttering with lots of different names and all sorts of bits and bizzos, all right? 3 types. There is an uptrend, there is a downtrend, and there is no trend. It's nice and easy, isn't it? Okay. I get a little saying that works very well for me. It's if the trend's not clear, it's not there. If it's not very obvious that I've got either an uptrend or a downtrend, I'm just not even interested in trading because I want to be going where the momentum is. If it's not clear, it's not there. Okay. Very straightforward, simple rules. Very powerful though. Helped me out a lot when I started, and it still does to this day. Now, a downtrend is where price makes successive lower lows and lower highs, as you see there on the diagram in front of you. And look, if you're taking notes or whatever for this, this is a really important one to take because, like, as I say, trend and price action is just such a big part of anyone's success as a trader, obviously if they're trend followers. But the definition is really quite simple in itself. I think a lot of people tend to, in my experience, overcomplicate trend. It's simply, for a downtrend, it is no more complex than this. There are lower lows and lower highs, followed by further lower lows, further lower highs. That is it. Nice and simple. If you either draw the zigzag going down and write it out, or just capture what's on this slide, it will serve you. Okay? A trend trader will look for reasons to trade short with the majority direction of the trend. Note, however, that this is just one ingredient. Don't mistake trend trading for a complete trading strategy. Just because something's in a downtrend certainly does not mean you should look to go short. Doesn't mean you just sell short. You need to pinpoint the point at which you're going to enter that trade, where your stop's going to be and where your exit point is going to be. We're going to get to that later on. So here we go. We're looking at Euro Oz, so EUR AUD on a weekly chart. This example, the Australian dollar is in demand versus the euro. Put the other way around, traders and investors are selling the euro to buy the Aussie. Okay, so the euro is being decreased in value because the Aussie is strong, pretty much, to make it in very plain English. Okay, this is represented visually by a weekly chart that is in a downtrend. Now on this weekly chart, this is what we want to see. Nice clear direction, nice clear selling momentum. Clean, smooth flowing charts. That's what we're looking for. Clean, smooth flowing charts. And this is exactly that. Beautiful looking chart structure, beautiful looking trend. And this is the type of market that will serve you. Now, of course, this is a weekly time frame. If you went down onto the 2-hour or the 4-hour or something, you'll probably see a very different picture. We'll just focus on the time frame that we're looking at right now, which is weekly. Now, an uptrend is, you probably guessed it, exactly the same, but on its head. Okay, so it's the opposite of a downtrend, where price is making higher highs and higher lows. This represents buyers controlling the market over sellers at this point in time. And again, good to take a note down. What I did, just a heads up, I mean, for what it's worth, I know some people might not want to do this, but some people will. What I simply did was I just draw in that squiggly line. I would do that, And if I could see a chart that looked like that with higher low, higher high, higher low, higher high, then I was saying to myself, that's an uptrend. It's a simple definition. It's simply set up, but simple things can often become complicated if you don't remind yourself, often by having visual aids to pull you back on track. Here's a beautiful daily uptrend of dollar yen. So in this particular chart, dollar is strong. Okay, yen is weak against the dollar. Now, in saying that, if you were to look at other pairs where the dollar is involved, they might not look like this. Just because US dollar yen is in a wonderful uptrend doesn't mean US dollar Swiss or US dollar CAD or US dollar Aussie is also going to be showing strength. What this is showing us is that the US dollar is strong against that of the yen. Okay, what that means is it results for us in a wonderful looking uptrend like this with many opportunities for us as traders to be able to trade. Now, I did say there is an uptrend, a downtrend, and no trend. So let's have a look at the latter. You can see here there is no clear trend. We have no clear series of higher highs and higher lows. We have no clear series of lower highs and lower lows. This represents to us a lack of commitment, an uncertainty. Now you'll hear, many people in the market say uncertainty kills the marketplace, and it does. If people are uncertain, it's not good. This is what uncertainty looks like on a chart, and when a chart looks like this, it's just a lot easier to really avoid it. If it's not clear, it's not there. Remember, when you're trading, you don't need to trade often to trade well and to make money. You need to trade well. And focusing on what's going to help you to trade well through your strategy, through flawless execution, through the use of the correct broker, and through the use of trend, that's what's going to keep you focused. Don't get sidetracked by all the flashing lights buzzing around. Focus on what you need to do in your space, because it's all up to you. Okay, your success is up to you. So Kiwi yen here, there's no clear trend, and you can see on this chart it really is just all over the shop. I mean, to put it, probably the easiest way to put it is we're sort of ranging through here and up through here. Some people like to trade range-bound markets, and that's fine. I'm certainly not saying that you can't make money doing other things other than what I'm telling you, but I'm going to show you how we do things, how I can help you guys with some trading strategy. And certainly I don't trade in ranges. I personally find it a lot easier to find where the trend flow is, to find where the money's moving, and to wait patiently for my opportunities. Okay, so that's a no trend. Leave that one alone. Now, I said a moment ago that there's there's three types of candlesticks, and I meant that. I mean, there's obviously they come in all different shapes and sizes, but once you understand the psychology behind the certain candlesticks, you'll really start to understand a lot more about your own trading, provided, of course, you use candlesticks. Now, you got bullish candlesticks where the buyers have won the battle over the sellers during that time period. Now, let's just say, let me just get my little drawing tool out again. I might make it a bit more of a bright color. How about we go for pink? There we go. Okay, so what we're seeing here is the name Hammer. Okay, Hammer, whatever, Trevor. I'm not interested in the name. What I want to show you here is what the candle's telling me. It's telling me that we opened here, we closed here. Let's just say that was a 5-minute candle, just for argument's sake, just to make it nice and easy. All right. Price opened at this point and it sold off. At some stage throughout that 5 minutes, price was all the way down here, and that candle was a big, thick red candle. Then, for whatever reason, price rejected this level and it closed up higher. The psychology behind that candle is saying that there were sellers, but they retreated. Don't need to know why. It's not important at this stage. At this stage, it's not important why they retreated, but it closed higher. That's a very bullish candle now. Okay. Over here, you can see this is called a gravestone doji, where it opens and closes at the same level, but you can see the range. This is also a bullish candle, but it's a bullish candle with a fancy name. Now you can see here, we've got 6 names for candles. You've got the bearish candle over here. The same sort of idea is that it opened here, moved up to here, and then was shoved all the way back down to here, closing bearish. This one, same sort of thing, closes bearish. Why? Because price was up here and it went all the way back down to close here. It still closed up, okay, on where it opened, but it's bearish. Over here you've got Dragonfly Doji opening and closing at the same point, but price has rejected these highs. This is a bearish candle, or examples of bearish candles. Indecisive candles look like this, your doji or your spinning tops, where price doesn't really move beyond too much where it opened. There's equal highs to lows, or doesn't need to be equal, but relatively similar highs to lows there in the range. Let me help you with something right now. The names of all of these candles, and I'm sorry for anybody who's gone out and read candlestick books. I'm not trying to upset anybody, but here we go. Cross them all out. Why? There's a lot more candlesticks than just this to represent bullish and bearish and indecisive. However, once you understand the psychology behind the candle, it really means nothing as to what the names mean. Would you rather remember every single candlestick in the candlestick dictionary by classifying them as bullish, bearish, or indecisive, therefore giving you a tool that you can understand and use with a bit of clarity and conviction? Or would you rather know 667,542 candlestick names? No. Keep it simple. Make it easy to get it right, because if you make it easy to get it right, it's harder to get it wrong. Bullish, bearish, indecisive. Clarity, structure, straight up stuff. Okay? Get rid of the fluff. So, how do we use these small candles? Why do we use them? What do they mean? Well, here obviously you can see that we've got a wonderful uptrend. We see higher highs and higher lows coming in and just trading very, very well. We're looking at dollar yen on the daily chart. What a wonderful, wonderful world it would be if we were like this all the time. Now, as we pull back, let's have a look. Let's just highlight where these candles are. Small candle. What happens after the small candle? Good move. Small candle. What happens after it moves? Okay, it's not necessarily a good move there. Another small candle, good move. Another small candle. You get the picture, right? These are bullish candles, move. Okay, that's not small. Smallish candle, good move. Smallish candle. Remember, though, we can only make money from this side of the chart. Whatever happened back here means nothing unless I've already traded it. But I am certainly not hindsight trading, because we never do that. I despise saying, look at how well my strategy works here and here. I want to see live screenshots like here. That aside, the most important thing for this slide is just to show you what happens when there are small candles. Now, another thing, I am certainly not, okay, I'll make this very clear, I'm certainly not suggesting that just because you get a bullish candle and an uptrend, you buy. Okay, remember, we're not yet at the strategy. We're working through the ingredients. Okay, so you can just see what happens when there's a small candle in this zone, and we'll talk about this zone later on. When it comes into this zone, we move away. Very powerful there. Now, support. If price hits a lower level twice and reverses, support is formed. The level represents accumulation. Buyers overwhelm sellers at this point. So what's actually going on here is this. Price comes down here. 1 means nothing. 2, okay, support. Now we've got a third test of support. So each time price comes down, buyers are snapping it back up and driving it back up a bit. Then it comes back down. Buyers are snapping it up. Buyers are snapping it up. Now, there's no strategy on this right now. We're not talking about a strategy at this point. We're just teaching support. You need at least 2 tests, at least 2, for it to be classified as support. If it was just 1, then there would be support and resistance everywhere. It needs to be 2. And please understand, I'm not saying we trade the break of 2 tests. I'm just introducing you to support. Again, it's not a strategy just yet. It's an ingredient that we're looking at. Okay, so support is underneath price. So like the floor under your feet is supporting your weight. Price 2, when it flattens out at a point, like you can see here at least 2 times, that is support on our price charts. The other side of this is resistance. If price is moving up and it runs into a level and it hits that level and it fails to break it on more than 2 occasions or more, what have we got? We've got resistance. Once again, the level represents distribution. Sellers overwhelm the buyers here. Each time price runs up into this level, sellers drop it back down. Up in, sellers drop it back down, so on and so forth, until it actually breaks through it or completely rejects it. But it needs to be at least 2 tests above, and it's the ceiling above your head. So just think resistance, ceiling, support, floor. That way you can remember top and bottom, okay? Oh, and the technical analysis is powered by auto chartists. Now, the good thing about this is it's automated technical analysis. You get continuous intraday market scanning on MT4, and it helps you to stay on top of market movements. Basically, because it's continuous, you can see what's going on. You can identify key horizontal support and resistance levels that indicate market sentiment on various tradable instruments. Now, this may be useful to filter or to highlight key levels as you can scan and decide if an opportunity exists for you. So if you draw in a support or resistance level and nothing's going on with it right now, and then you come back in 3 or 4 hours time and price is running into it, well, at least you've drawn the level in, so you know it's valid. Okay? Once it's there, it's there. Okay? Now you get free access to all Auto Chartist tools through an Amanda Live or demo account. Auto Chartist scans for potential chart patterns and Fibonacci levels. Now, just remember this, your demo account is for a limited time only, and your analysis is delayed. So, great to go in and get a live account and get started. I'll tell you some more benefits of having a live account towards the back end of this webinar. So here we go. We're looking a bit more at our price structure at this point. And what we want to really focus on is this. Price support can accumulate over a large period of time, and once broken, it often becomes resistance when it's retested. So what I mean is you can obviously see throughout this period we had support, 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 resistance, resistance, resistance. Now what's actually happened, and this is the prime example of a range-bound market, we don't have a clear trend just yet. Price has broken down, it's pulled back in to test that level. Quite often when it's retested, you'll see the price will then fall off from there. Doesn't always happen. It's not a 100% rule, as none of these are in terms of, you never know what's really going to happen. We're here trying to teach you some strategy to give you a higher probability of success. But often old support becomes new resistance. Now, because old support becomes new resistance, you guessed it, on the flip side, old support can become new resistance when it's retested. Something else to notice as well. You've got round numbers. Numbers that end in double O or triple O or even better quadruple O result in a lot of orders placed around these levels, which help support and resistance levels. It also it's a level. It's a psychological level. When it's anything in the market that us traders are looking at and investors are looking at, you notice those sorts of things. You're not going to notice 1.2487. Why? Because it's just a number out there on its own. You are going to remember 1.2000. Because it's a round number. And because of that psychological effect that it has on us human beings, which are obviously ruling and trading and moving the markets, it is a level we need to be aware of. Now, parity is one of those. This is dollar Swiss with parity. You'll see it on dollar CAD, anything that's near parity. You'll see how price reacts around these levels. Parity is probably, parity is the biggest of the numbers, really. Okay, people are very aware of it, and it's not just because you're a trader. Generally, if a currency is approaching parity with another, it's generally on the news. I know recently there was one on Australia and New Zealand going into parity or looking likely to do it, around dollar CAD as well, around dollar Swiss. You hear a lot more about it, so it puts it into the public domain. And that is why those sorts of levels represent a level of support and resistance, and you'll quite often see it visually on the chart as well. A lot of orders around those levels. Just be aware of it more than anything else. Just because price is coming up in a parity from the underside doesn't mean I should sell it. No, it means you don't do anything different. You just understand that it's there. And possibly when you have a nice trend, look for trades off it depending on your trading strategy. Now we're going to have a look here as well at poor price structure. Now, the thing with sloping trend lines is that they're very subjective. Okay. Now, as traders, we want to be objective. We want to have a set of rules. We want to stick to them. We want to know what we're doing. We want to remain focused. The thing with sloping trend lines, and I certainly can certainly talk from experience when it comes to sloping trend lines, because as I said, for that period when I was starting out as a trader, I did a lot of things wrong. It's very hard to do things right when you don't know what's right and wrong. But I was drawing sloping trend lines, and it took me quite a long time to really, I guess, wean myself off them. Sloping trend lines are very subjective. You can tweak a sloping trend line. If your strategy was to be, and I'm just giving a hypothetical, just an example, sorry. If your strategy was to be buy when it bounces off of here, it's not quite testing, it's not quite touching that level. So what do? You just move the trend line just a little bit. Oh, it's touching now. Cool, I'm going to take that trade. Yay. that's not going to serve you over the long run. Okay, it's not going to serve you. The other thing about sloping trend lines is, what are we in, an uptrend or downtrend? Where is the trend? You've got trends within trends within trends within trends within trends. And it can get very hard to differentiate what is real and what is just a bit of noise on the chart. So therefore, really don't use sloping trend lines. It's very inconsistent, and it can often result in analysis paralysis because you've got conflicting messages, you've got trends within trends, you're tweaking this line, you're tweaking that line, should I trade from here, yada, yada, yada. It just clouds your vision, and you want to be clear when you're trading, not clouded. So what do? We don't use these sorts of sloping trend lines. We do, however, bring in moving averages. Now, moving averages are an indicator. Let's be very clear of that. But what they actually are is a mathematical average of price. Now, what they do is they smooth out fluctuations in price, and they help to highlight trends. Okay? Now, we use 4 simple MAs. The long term is the 200. The medium term is the 50. The short term is the 10 and 20. Now, you can see there they are color-coded with black, blue, red, and green. Now, what do I mean by 200 period? Let's say that this chart, or this example that we're looking at right now, let's say that each one of these candles is an hour. It's 60 minutes. Okay? Each one of these candles is 60 minutes. So what I'm saying is this. The 10 period moving average, which is the black one, is taking in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And each new candle, it's making that line slightly different to take in that the previous candle, and it's smoothing out this price action over the last 10 candles. Now, for the 20 period, it's doing the last 20 candles, hence why it's a bit behind the 10. The 50 is doing the last 50 candles, and the 200 is doing the last 200 candles. Now, that remains the same whether you're trading off of a 15-minute chart, a 1-minute chart, a daily, weekly, or monthly. 200 is 200 bars, or 200 candles, okay? 10 is 10 candles. It's just smoothing out that price into something that's a bit more averaged out in the form of a moving average. Okay. Now, with our moving averages, because we use them for a zone, they're not an absolute science for how we trade around them. You can use simple or exponential. It's completely up to you as to what you use. Whoops, a little screen malfunction there. I don't know what happened then, but we're back. It doesn't matter if you use simple or exponential. The choice is yours, because you'll learn later on that we're looking at more of a zone. And the moving average geometry helps us to find and confirm a strong trend. So the geometry is important here with the way we're trading and to working with our trends. We want all of our moving averages either rising or declining. Okay? We want them all rising or declining at a similar angle, and we want them to have space in between them. When it's got all of these things, the moving averages are said to be fanning. Now, if you're very new to trading and this vocabulary and this lingo is a little bit confusing, let me bring it to you in a very simple and practical way to use it. When it comes to moving averages, what you want is this, and bear with me. You've got 4 fingers and a thumb, okay? Forget your thumb, because your thumb's not a finger. You've got 4 moving averages. If you hold your hand out in front of you and you spread your fingers apart, you'll notice that they're roughly the same sort of distance apart. That's what you want in your moving averages. They don't need to be identical distances. They don't need to be picture perfect. You just don't want them crossing over. You don't want them in a mess. You want them like your fingers, out in front, spread apart. Spaced out is what we're after. That's what we mean by the word fanning. I know it's a bizarre way of doing it. It's just something that I picked up, and it really reminded me of how to know what I'm looking at and what the word fanning actually means in a visual, practical sense. You want them in the same direction, so in this case, all facing down. You want them nicely fanning. Now, this adds a new set of ingredients to our trend analysis. We've got 4 moving averages confirming the current market direction. So they're another checklist for our strategies. So how do we use moving averages? Well, here it is here. Now, first of all, we're going to look at the buy zone. Now, the buy zone is the period in and around the 10 and 20 period moving average. Now, before the question comes up, this highlighted yellow area, is this an indicator that you can use on a Wanda? No, it's just simply a slab that's been colored in with a yellow pen. The zone, and this is why we say you can use simple or exponential, it's not really that important. The zone is in and around that 10 and 20 period moving average. So the black and the blue. Now here's what I want you to really focus on. Price moves away, pulls back into the averages, then it moves away, pulls back in, moves away, pulls back in, moves away, pulls back in. It's a point of equilibrium. We said that price doesn't always just go in a straight line, it always pulls back. This is how our trends operate. This is a trend. This is where we're pulling back into. This is our buy zone. Okay. Now again, I'm not saying every time it comes into the buy zone you should buy. This is also an ingredient. The flip side is this. It's a sell zone. Back into the sell zone, move away. Back into the sell zone, move away, back into the sell zone. Probabilities with the trend, with all these factors, moving averages, fanning, we're starting to build a strategy. The probability would be to see it fall further. Moving averages indicate dynamic equilibrium between buyers and sellers. When price pulls back into these averages, for me as a trader, doesn't mean I'm going to trade, it means I'm now interested. Okay? That's the main thing. So let's go into the strategy now and learn this recipe, the trend flow strategy. We've already defined a strategy as a set of rules defined in advance representing our plan to trade the market. Some key principles of the trend flow strategy are strong price trends. We need clear trends. Trading the direction of price momentum, bullish or bearish candlesticks to confirm, focus on the big picture with multiple time frame analysis. A key part of this strategy is to apply very strict money management rules. A trend is present on a minimum of 2 time frames. These are your rules. Write them down. Take a screenshot. Do what you will. So number 1, a trend is present on a minimum of 2 time frames. 2, moving averages are fanning with space in between them and are at similar angles, like your fingers. Number 3, setup is defined by a bullish candle in the moving average buy zone, if in an uptrend, of course, a buy zone for only going up, after a pullback. This is providing you with a long setup. Okay, so a bullish candle in that zone. If you're in a downtrend, you want a bearish candle in that zone. Okay. Price breaks the high if we're looking to go long of that candle for our entry. And obviously price breaks the low of the candle if you're looking to go short. Your stop losses are a prudent risk management tool, preferably with strong price action structure or trend high or lows protecting it. This will all fall into place when I show you an example, don't worry. Number 6, consider limiting a maximum of 1% of capital on each trade. So if you've got 10,000 in your account, look to risk $100. Keeps your account safe if you have a couple of losing trades. OANDA clients may attend additional free premium courses to learn more about the trend flow strategy. This is one of the strategies that we cover in great detail on this premium education for live accounts. It's going to be launched February 3rd. If you want to know more, I'll show it to you in a moment. You want to stack the probabilities in your favor, so there's some additional ingredients that we can add to help improve the probability of this strategy. You need indicator convergence, trade only with the best trend, so when they're in agreement. You want candlesticks. The smaller the candles, the better. The smaller the candle means that the same amount of 1% risk with a small move in your favor can end up resulting in a much, much higher or better profit. Colin, I think you're off mute there, mate. If you could just jump back on, that'd be great. Support and resistance, we're looking for good price structure. Okay, so we want a nice level of support and resistance to be bouncing there off of. That's an important part of this. It's a bonus. It's not an essential, it's a bonus. And also multiple higher time frames. So you're not limited to just staring at one time frame. You've got plenty to look at. So let's have a look at this strategy in action. Now, as I say, I never hindsight trade. We always look at live screenshots. And this is a live screenshot taken just as we've been filled in this trade. So what you can see here is we've got, and let me just recap a couple of things back to you. We've got higher highs, higher low, higher high, higher low, higher high, pull back into where we're pulling back into. We're pulling back into this buy zone. Okay, pulling back into this period, but in and around the 10 and 20 period moving average. We now have a good uptrend. We now have a good pullback into the averages. Nice fanning moving averages. We have a nice small bullish candle in this buy zone. Our entry is where that red dotted line is. Let me get rid of those dotted lines now. And our stop loss will go underneath the low of that candle. So we're straddling that candle for our order. You come up now and you have a look at the 4-hour time frame, so going from 1 hour up to the 4-hour. And the main thing we're looking at here, do we have confirmation of trend? And what we see immediately by understanding trend is here's our low, here's our higher high, here's our higher low, and here's our higher high. We have ourselves a confirmation that we've got a backup for our trade. So we've got a number of reasons why we would look to take that trade. And this is just an example. There are many different ways to trade foreign exchange, ladies and gentlemen. We're showing you an example of one of our trading checklists, and you can see that there. Now here's the follow-on slide from that. You can see the outcome of this particular trade, and you can see, obviously, this one worked out. Do all of our trades work? No. I'm certainly not suggesting that, no. We are real people, real traders. You need to understand that not every single trade is going to make you money. So what do we do? Because the outcome is never guaranteed, we want to manage our risk always so that our losses are within our own managed means. Okay? Never lose more than what you've already structured or what you've already said that you can afford to lose. So, minimizing your downside risk. A risk management plan is absolutely essential to minimizing your downside risk. Now, with risk, you can see there's three aspects to risk management and having the plan. First of all, if you're going to be a trader and you're going to have a real go at this, you need to accept risk. Okay, it's there. It's always going to be there. Now, the beauty of accepting the risk is now we can take care of, reduce, and avoid. You can avoid taking excessive risks by planning your trades before you take them. Having a trading strategy in terms of the technical sense, having a checklist in terms of the technical reasons to look for a trade is to find a trade. There's much more to a trading strategy than just finding a trade. There's your risk management plan. So accept the risk, avoid the risk, avoid excessive risk. So how do we do that? Well, we look to risk about 1% or less. Okay, obviously that's not going to suit everybody, but that is a very good level to start at. And you can reduce that risk. Okay, so avoid the risk, reduce the risk. Don't take excessive risk. Now you can tailor your plan because each trader has a different appetite for risk. Not everyone's going to want 1%. Some will want less, some will want more. The best traders almost always limit the amount they are willing to lose on each trade. So you can make a dollar value on that, whatever you like. Example, 1% or less of their trading capital per trade is very common among professional traders. It's wise to always use a stop loss. When you hear of horror stories within trading in the trading community, it's generally due to somebody either forgetting or just not using a stop loss. Okay. Now I do hear people say I often get stopped out, so I don't use a stop loss anymore. That's not a good enough reason to not use a stop loss. Okay. If you're getting stopped out often, you need to change the way you trade. You're either putting your stops too tight or whatever. Okay, there's a number of reasons why that can happen, all of which I'm not going to go into in detail right now. So let's have a look at some of the tools that you actually have through Oanda right now at your disposal. Placing a limit order on your FX trade. It's a number of steps. First of all, once you've found the trade that you're after, you can go into this little deal ticket and you can see here limit order. Once your trade is planned, select limit order and check either buy or sell. Obviously, whether you're going long or short. Don't forget to do this. You may similarly select market order, and market order means you want to get in now. Okay, click, I'm in, boom. That's what a market order means. A limit order is you're going to get in at a predefined price. Number two, you want to enter the volume for the trade. So how many contracts or how many units do you want to take on this trade? In this example, we're going to go for 10,000. The next is you want to put in your entry level. So you can see it says, quote, we're going to get in at 1.37601. So we put in the predefined level based on our trading strategy where we want to get in the trade. By the way, don't pay any attention to the chart right here. We're paying attention to the deal ticket. Number four is you enter your desired stop loss level to limit your downside risk if you're wrong. In this case, we have 20 pips of risk. Note this is an example only, and stop size will vary according to your trade and your strategy. So to go in there and always use a 20 pip stop is not the right thing to do. You need to have your strategy and you need to read what your chart is telling you as a logical, safe place for your stop. Number five, if desired, we can enter a point at which you wish to take profits. Now this is fantastic for those of you who do have a day job. For those of you who don't want to sit there and stare at your charts all day, for which I am one of you, okay? Use limit orders. It's fantastic. You can put your entry, your stop, and your limit. Walk away. One of the three is going to happen. You've accepted the risk. You've managed the risk. You also know what your upside potential profit-wise is. Your job's done. Put your trade on, walk away. Come back and check it when you can. You're either in the trade, in which case you're either going to make a profit or a loss, which is fine because you've managed both, or the trade's become invalidated because it's broken down through where you want it to be out, and therefore you cancel your order. Number six, margin required for the trade and potential profit and loss of trade based on stop loss and take profit settings. So it will tell you, your potential profit, your potential loss. You can see here we're going for a maximum of 1-to-1, so risking $22.40 and looking to take $22.40. Orders with bounds. Orders with upper and lower bounds are set by checking the lower bound and upper bound boxes. You'll see that right here in your deal ticket. If the market falls within the bounds set, then the order will be executed. If it falls outside, then the order is cancelled. This is a function that I think is absolutely wonderful. This means that you can go into the market, if you're going to raise an order and walk away, or even just raise an order and be around, you can go in there and say, look, if it gaps above this level, for example, or if you can't fill me at the level that I want between here and here, in this case, it's roughly about 6 pips, then I don't want to be in it. Now, the beautiful of that, it's going to limit your slippage because you limit the slippage. You say, right, I don't want any more than X. It also prevents unwanted order execution in the event of a rapid market fluctuation. Basically means that if you don't get what you want, the order gets cancelled. What this does, what this says to me as a trader is that it helps me to further limit my risk. Now, as a trader, my job is to manage my risk, to limit my risk, and to really protect the capital I've got. With protecting the capital I've got, then the next thing to do is to make money on top of it. Any feature where I can minimize the risk is absolutely essential for my business plan, and you have it right here with Oanda. You've got a phenomenal, easy to use, very structured, very clear set of ordering systems, and this whole bounds order is just, it's really, really worthwhile your time. Now, placing a stop loss on Oanda and MT4, you've got another option here. Once your trade is planned, select the pending order and either buy or sell stop limit. Sorry, stop or limit. You've got a stop order or a limit order. Step 2 is enter your desired entry price by going in here at price. So you've chosen your type, you've chosen your order type, and you put your price in. Enter the volume for the trade. So we've decided we're going to go 5,000. Sweet, just trading small. Number 4, enter your desired stop loss level to limit your downside risk if you're wrong. In this case, we put 20 pips. Once again, I will put that risk disclaimer in that 20 pips is not what you should always use. It will depend on the trade itself. You've also got a take profit window over here. You can see what we're looking for is a profit of 20 because we're entering at 5720, getting out at 5740. Put that in. It'll take us out at that price as well. The desired outcome. So one can't bake a chocolate cake with just chocolate alone. One can't bake a cake. So you can not bake a cake without a good recipe. By following a trading strategy and keeping to your rules, this will help you assess the strength of your strategy over time, as well as your ability to execute this strategy well. There's no fast track to trading, ladies and gentlemen. Unfortunately, it's not get rich quick. It does take a bit of time. It is a profession like any other. The way to do this properly, though, is to manage your risk from the outset. It gives you a chance to survive the learning curve. Okay, it's really important that you do this. Now we're going to show you a little bit about the premium client only webinar series and show you what you can have as being a live account holder through Oanda. What you're going to get through this premium service is a program called Forward Thinking Traders. Now it's exclusive education for Oanda clients only. The good news is there's no minimum account balance or trade volume required. You just need to have an account balance. You can learn a simple, easy to follow approach to technical analysis. We basically just fill out what we've covered in this evening's webinar in a lot more detail. Forward Thinking Traders is a premium technical analysis and trading strategy education course with a modern approach to charting to formulate simple, logical trading strategies. This is an 8-hour course conducted by 4 2-hour webinars that is run weekly. Now, in these webinars, what we're covering on these 2-hour sessions is a lot more detail in things like trading strategy. What we've covered in this very short 1 hour tonight is a lot to do with one of our trading strategies called the trend flow. You will learn that in its complete form with a lot more time, a lot more practicals, a lot more work done by you. You will be practicing it and going ahead and doing it yourself. Now, it's broken into 4 2-hour chunks for this exact reason. We don't do it in a full 8-hour. You'll also learn another strategy called a momentum breakout strategy. Full strategy there, you'll have 2 complete. We also cover areas like how to manage your orders, how to take your screenshots, how to understand your psychology, what good traders do, because to be a good trader, you need to focus not on the money to start off with, you need to focus on doing what good traders do. Watch this space. It is coming out in 2014. We are there, from my understanding, it's coming out February 3rd. So have your accounts opened and funded by then. Something else that we can have a look at here is on the Oanda website right now. If I click on Forex Trading and I come into here, I have Why Oanda Products, Learn, News and Analysis. If I click on Learn, as I have done right here, what it shows me is this little screen. If I now come into Forex Trading Webinars, I can click Sign Up Now. What you'll now see is a calendar of the events that we have coming up, dated, time, topics, and what we're covering in these webinars. Now all you need to do to register for these is simply click on this, register your interest, and away you go. So it's very simple to do that. We've got many, many more webinars coming up, so I'll leave that for you guys to register for some more. How do you actually open up a live trading account so that you can take advantage of this premium education program that we will be running from February 3rd called Forward Thinking Traders? All you need to do is this. Visit www.oanda.com or email frontdesk@oanda.com. They've got a 24-hour team.